welcome back, guys, to another roundtable. My name is Adam. With me today, Victor, Rusmin,
Hi, everyone.
Hello.
Baby Yoda as well. Kenny has left something behind. So Yoda's still the fifth person joining us today. And today we're going to talk about banks, Singapore banks. I think National Day just passed recently. So I think it's a good time to talk about Singapore and our banks. All right.
Yeah.
So we've actually spoken about banks a couple of times on this roundtable, and the very first one was August last year, 2020. It was 1 year ago. And the banks have done really well since then. When we covered it, I think share prices have gone about 40% for all three banks. So we're going to talk about banks. You know, the share price has been tremendous. We're going to talk about their performance as well. And recently, the MAS lifted the dividend cap as well. So we're going to talk a little bit about that. So maybe just a quick recap. How are the banks doing right now since, you know, from 2020 last year till now? How are they performing?
I think in terms of performance, people just simply look at the dividends, right? So let us look at the dividends for the banks. And you know, they have actually, most of them have announced the first half results. So if you look at the first half result for OCBC, the dividends have actually gone back up to the pre-pandemic level. Okay, so about 25 cents in 2021 for the first half as compared to the 2019 25 cents. Okay, so 2020 they were actually a lot lower at 15.9 cents. Okay, you look at the UOB dividends also has actually gone up higher as compared to the pre-pandemic level. In 2019 the first half is about 55 cents and first half of 2021 is about 60 cents because they actually increased the dividend slightly as compared to the pre-pandemic level. Okay, for DBS, I think in the second quarter they actually increased to about 33 cents versus 2019, which is about 30 cents. Okay, so but in the first half of 2021, it's still slightly lower as compared to the pre-pandemic level. Yeah, but I think moving forward, they may continue to increase the dividends.
Yeah, I think you must take note about DBS is because they pay quarterly dividends as compared to the UOB and OCBC, they pay half-yearly dividends. Okay, so because their quarterly dividends that they give the first quarter, right, was still within the restriction. That's why it was lower. But if you were to assume that they go back, right, actually DBS and UOB increase their dividends as compared to OCBC.
Yeah, so I think the MAS only announced it in end of July, 28
July.
There was a 60% cap for those who, can't remember, it was 60% cap on dividends for Singapore banks.
Yes, correct.
Yeah.
So now that has been lifted. So all three banks have returned their dividends to pre-pandemic levels.
Yeah.
Correct.
This mainly because I think their first half for the 2021 in terms of net profit, I think for OCBC actually has improved to about 2.6 billion, about 86% versus the so-called the first half of 2020.
They are led by the wealth management hitting record.
Yes,
So,
yeah.
Okay, so a lot of people investing during this period.
And also mainly because of the lower provision for loan losses across all the three banks.
Okay.
Right. For UOB, their net profit also has improved about, I think, 29% to about 2 billion from 1.6 billion. And for DBS, it has also improved, I think, about 54% to 3.7 billion.
Yeah. So the best among the three banks is actually the OCBC, which they have been talking about their wealth management, private wealth management, and it's really showing the result right now. Right?
Yeah.
Okay, so looks like dividends are back. Do you think any risk of dividends being cut again? Do you think that there's going to be a surprise down the road? Because I think a lot of people who are investing, they're happy that the dividends are back, but if it's going to be cut again, what do you think is going to happen in the next 1 or 2 years?
I think the probability, but of course there's no 100% sure, but investing is all about probability. I think the probability of dividend cut is very, very low, right? Because if you look at the bank's current position, right, they are much stronger as compared to the second quarter 2019. So if you see that the CET1 ratio in second quarter 2019, right, for OCBC is about 14.4%, OUOB is about 13.9%, and DBS is about 14.5%. So if you compare right now to OCBC, right, they are at 16.1%. Previously, they are 14.4%. UOB is 14.2%, previously 13.9%. But then for DBS, right, they are still maintaining the pre-pandemic CET1 ratio, which is at 14.5%. So if you talk in terms of banks, right, OCBC and UOB are much stronger right now in terms of the CET1 ratio. Okay, and if you were to look at the CASA ratio, which is the current account and saving account, which is their low-cost funding, right, UOB's CASA ratio is about 52.7%. OCBC is about 62.5%. Right, so usually these two banks, right, at the pre-pandemic, they are at about 40+%. They usually have much lower CASA because they are not the nation banks, right? But then they have increased, especially OCBC is much higher. DBS is at 76%. They increased up from 60%. So DBS have always have much lower cost funding as compared to the other two banks. But I'm quite impressed that OCBC actually went up the CASA ratio to as high as 62.5%. So in terms of the strength, right, I would say that the OCBC and UOB have gotten much stronger as compared to second quarter 2019, and DBS is roughly probably still maintaining.
All right.
Yeah. So in terms, I think professional for loan losses also, DBS generally are more aggressive. You can see that their loan for professional losses are actually a lot lower, 95% lower, as compared to UOB and OCBC is only like 40% lower. So they are like already expecting that full recovery. So they are not setting aside the loan losses and that. Okay, so that's why I think they started to lift up their dividends, right? And generally, I think for our DBS are actually a lot more aggressive compared to the rest.
Right. So it looks like all three banks are actually very well capitalized compared to even pre-pandemic levels. And of course, I think maybe no one will really know because I think the MAS is the one that decides whether dividends are going to get cut. But based on what's happening with the vaccination rates, things
Singapore's at 70% right now.
Yeah, 70%. Congratulations. I mean, we're all double vaxxed as well.
So I've got two jabs.
Right? So it looks like things are like turning a corner. There's light at the end of the tunnel. The economy, I think there was a news report today or yesterday where the Singapore economy is expected to grow 6 or 7%, which is extremely high actually, not too bad actually.
And the bank grows with the economy.
The banks are kind of like the backbone of our local economy in a way. So 6 to 7% growth is pretty good. So it seems like things are looking up. Right? So I think it looks pretty good.
That's why I think MAS actually lift up this dividend cap, right? And I think the managing director of MAS actually says that the banks in Singapore have actually weathered the pandemic very well. Even if things were to go worse from here or vaccination delay, I think the banks, basically their CET1 ratio and all that, would be able to cushion the fall.
But of course, as I mentioned in the previous video, that the Singapore banks are very well capitalized, right? So the MAS is just being very conservative as usual, as that's what MAS always been doing. They are very conservative. So even though they don't have the cap, right, the banks also is very well capitalized. But in fact, because of the cap, right, now the banks are way much stronger. Right?
And they're really take advantage of what's going to happen in the next 1 2 years, assuming that the economy and everything else is going to just get even better from here on out. So I think the question is, a lot of people who watch this, investors and all that. I mean, congratulations if you watched our roundtables from 1 year ago.
First video.
I think it was first few videos on. I think the very first time we did all this roundtable, we did pick Singapore banks. If you invested in the Singapore banks back then, you'll be sitting on about 40%. 30-40% profit, which is extremely good, and your dividends are a lot higher now as well. So I think a couple of questions. Number one is, if someone who didn't get in last year, would you still invest in the Singapore banks at this current prices because they've gone up so much? So I
would say that the Singapore bank is still much attractive, right? If you look at the previous video that we talked about, we said that we are waiting for two catalysts to happen. Okay, the first catalyst is the lifting of dividends, which happened already. That's why you see that the price went up. The second catalyst is actually the increase in interest rate. Okay, so if you look at the bank loans, right, they are much higher as compared to in second quarter 2019. Okay, but of course all these loans are being taken at a lower interest rate, right? So but loans, we don't loan for 1 year, we loan for multiple years, especially the backbone of Singapore economy of HDB loans is loaned for 25 years, right? So all these loans is at a very low interest rate, and when the interest rate go up and moreover their loans have increased, right, we will expect the banks to be very profitable. So if you look at second quarter 2019, right, the interest rate of OCBC is about 1.79%, whereas right now OCBC at 1.58. UOB at second quarter 2019 was 1.81, now it's 1.56. DBS was 1.91, right now it's 1.45. So this is the second catalyst that we're waiting for, and if the interest rate increase, it will definitely benefit the bank. So like I think the Fed already said that they're going to increase the interest rate in I think 2023, right? So we can expect upside for the banks when this were to happen.
That will be a final run.
Right. So it's funny to see that the US Fed is it's like the Fed is like our Fed, but it's the US Fed. But we follow the interest rates very closely as well.
So but that a lot actually depends on the how we manage the pandemic, right? So I think regionally, I think in Indonesia, Malaysia, I think the vaccination drives a bit behind the schedule, and now we are seeing the Delta outbreak in China. So And banks like UOB and OCBC, they have a exposure, even for DBS, they have a 20-30% exposure in the Greater China and Hong Kong. So that will put a bit of uncertainties over there. Yeah, so I think hopefully next couple of years we should be able to, if you look slightly mid-term to longer term, I think we should be able to overcome this pandemic. Okay. So and then eventually interest rate will start to rise again.
All right.
Yeah.
So the bank is generally still quite attractive now, because if you assume that they were back to their pre-pandemic dividends, right? You are getting at least 4% or higher yield, okay, for the banks.
Even
right?
at current prices?
Even at current prices,
okay.
So the banks, I would say that as long as you can get 4%, it's very attractive, because you get your 4% is much higher than your special account in your CPF account.
Or is it the same actually? 4%.
Sorry, 4%.
I don't know if you get extra in your special account. I want to know how you do it.
No, yeah.
But 4%
So, but some of the
same,
banks, they are higher than 4%.
Yeah.
That's what I'm saying. You get higher than your 4% special account. Okay, and you still can enjoy the upside if the if the interest rate were to increase.
So there's the capital gain as well.
Yes.
The potential for that.
Right.
Yeah.
So if you base on the previous dividend in 2019, right, the pre-pandemic dividends, right, at 4%, OCBC is about 13.25. So anything below that looks attractive. UOB is about 27.5 and DBS about 30.75. But of course, all of us know that UOB and DBS actually increase the dividend as compared to OCBC. So their 4% yield may be much higher in terms of the price. Right?
All right. So your internal benchmark, if you want to invest for dividends in the local banks, will be 4% yield, because you at least want to match the CPF special account.
Yeah.
And then that's your benchmark basically.
Yeah, but of course, if you look at the price to book ratio, OCBC and UOB is still trading at below their average. Whereas if you look at DBS, they are already traded at one standard deviation above the average.
People loves DBS.
Yeah, everybody loves DBS, but then they are not cheap right now, I would say, in terms of price to book. But in terms of dividend yield and price to book, OCBC and UOB is still below the average.
All right, so I'm going to put you on the spot. If you pick one of the three, which one would you pick?
OCBC.
OCBC.
Yeah.
What about you, Rusmin?
I have already picked OCBC.
OCBC as well.
So I won't pick any today. But last year I picked OCBC.
I mean, we picked it last year.
Yeah.
Okay, we're not going to buy. I mean, no recommendation to buy or sell. But we basically bought the banks last year in August when we covered this in the roundtable. Right now, for us, prices have gone up. I think some people could be asking, "Hey, I bought in August and I'm sitting on 40% gain. Should I sell?" I think that's one of the questions that people could be asking. So, what would you tell people like that?
So I think for me, it would just holding true. The beautiful things about investing in banks is that you get paid while waiting for the market to recover. And then on the way, of course, you get to enjoy the capital upside. Okay, so for now, I think I'm just sitting on it, and then hopefully, once the interest start to go up, the prices will likely going to roll up. Then there's the time. It looks like there will be a lot of good news, right? And there will be a perfect time to start to not let go of the share. For now, I'm just holding it and then just getting the dividends. That's all.
I think there's still upside to the banks, right? Like I said, OCBC and UOB is traded below their average. In fact, it's okay to even look at OCBC or UOB. Moreover, UOB actually increased their dividends. Okay, but of course, when you look at DBS, they are already at one standard deviation above their mean. I think that's probably the reason why the CEO actually sold the share in May, right? So, so the one standard deviation above the mean is about 1.45 times price to book, right? And when the CEO sold, it's about 1.39 times. So that's very close to the one standard deviation above, right? So that may be the reason why he sold the share. I'm not so sure. But
I mean, there's a number of reasons why an insider would sell shares.
But I'm just basing on the valuation of DBS. So I think there's still, like what Rusmin has said, there's still a lot of upside to the banks. Even to date, I haven't sold my bank stock yet, because I think there's still upside to them. Right.
But for people who are happy with their returns that they achieved so far, it's always fine to let go, because there are always risks, right? I mean, we even though we are confident about the recovery, but you never know, next couple of years there will be bad news, new news that are coming in, because last year we were pretty much occupied by pandemic, and then next year the world is so uncertain, right? Today's
I think it really depends on the person's goals, investment goals, and portfolio composition and all that. It really depends. I think personally, if I'm happy with a 4% yield, I'm happy to hold on to the banks, because I got it at even cheaper prices, higher than 4% actually, right?
5%, 6%,
So I think that's actually fine. And it really depends on the individual. So again, not a recommendation to buy or sell anything. Please do your due diligence. We're not recommending anything. This is just based on the stuff that we're discussing right now and what we think about the banks, because actually we talked about it 1 year ago. We're just doing a follow-up at this point in time. So I think banks are, something that we will come back again from time to time, because I think it's quite a big thing in Singapore for us. anyway.
Yep.
So again, I think that's a pretty good wrap up of Singapore banks. I hope you like that update, especially if you're already invested in Singapore banks or you're looking at Singapore banks at this point in time. I think that's a pretty good one. Yeah. So thank you so much. Once again, my name is Adam. This is Victor.
Thank you.
Rosemary, you're the fifth person joining us because Yoda is still here. So once again, if you like our content, please hit the like button. Tell us that you like our discussion. We're doing something good with what we're discussing about. Again, subscribe to our channel. Many more roundtables coming up. And once again, thank you for being here, and we'll see you around again.